Good afternoon, committee members, members of the public. I'm calling this meeting to order to consider Bill 59, to enact a new act, my goodness, with respect to home inspections and to amend various acts with respect to financial services and consumer protection. So we'll have a report from the subcommittee. Ms. Vernile.
Thank you, Chair. This is a report of the subcommittee. Your subcommittee on committee business met on Wednesday, December 7th, 2016, to consider the method of proceeding on Bill 59, an act to enact a new act with respect to home inspections and to amend various acts with respect to financial services and consumer protection, and recommends the following. 1, that the committee meet in Toronto on Tuesday, February 21st, Monday, February 27th, and Tuesday, February 28th, 2017, for the purpose of holding public hearings. 2, that the clerk of the committee post information regarding public hearings on Bill 59 on the Ontario Parliamentary Channel, the Legislative Assembly's website, Canada Newswire, the Toronto Star, the Globe, and L'Express. 3, that the deadline for requests to appear be 12 noon on Friday, February 10th, 2017. 4, that should the hearings be oversubscribed, the clerk of the committee provide a list of all the interested presenters to the subcommittee following the deadline for requests. 5, that each caucus provide their selections of witnesses based on the list of interested presenters received from the clerk of the committee. 6, that the witnesses be offered 5 minutes for presentation and 15 minutes or 5 minutes per caucus for questioning by committee members. 7, that the deadline for written submissions on Bill 59 be 6 p.m. on Tuesday, February 28, 2017. 8, that the research officer provide the committee with the following: background material on home inspections, payday loans, and door-to-door sales from other Canadian jurisdictions, summary of testimonies by Friday, March 3rd, 2017. 9, that amendments to Bill 59 be filed with the clerk of the committee by 5 p.m. on Friday, March 3rd, 2017. 10, that the committee meet for clause-by-clause consideration of Bill 59 on Tuesday, March 7th, and Monday, March 20th, 2017. And 11, that the clerk of the committee, in consultation with the chair, be authorized to make any preliminary arrangements to facilitate the committee's proceedings prior to the adoption of the report of the subcommittee.
Thank you, Ms. Vernile. Do we have any discussion of the subcommittee report? Shall the subcommittee report be adopted? All those in favor? Opposed? It is carried. So, witnesses. Missing my list. Our first presenter then is the Canadian Consumer Finance Services, Mr. Tony Irwin, President. Mr. Irwin. If you'd have a seat, you have 5 minutes to present, and then we'll go 5 minutes to each caucus for asking questions. If you'd identify yourself for Hansard, so you'll be properly recorded, and then proceed.
Thank you, Mr. Chairman. My name is Tony Irwin. I'm President of the Canadian Consumer Finance Association. Mr. Vice Chairman, members of the committee, thank you very much for the opportunity to speak with you today with respect to Bill 59. I'm joined by my colleague, Melissa Soper, who's a member of our board of directors, and I will be spending my time with her today. The Canadian Consumer Finance Association, CCFA, represents 11 member companies who together hold 505 of the 819, or 61%, payday loan licenses issued in Ontario to offer payday loans. Our industry exists because many Canadians need small, short-term credit that is not provided by banks or credit unions. This industry grew in response to consumer demand, not the other way around. In 2015, our members granted approximately 4 million loans in Ontario. Clearly, this is a significant and important source of credit. I have with me today a box of petitions signed by borrowers who do not want to lose or have government restrict their access to payday loans. This box is just one of 20 boxes containing petitions signed by over 50,000 people. I'll repeat that, 50,000 teachers, firefighters, nurses, police officers, government workers, and other Ontarians who've taken out a payday loan in the last 3 months. This product is important to them. Payday loans are costly to provide. Banks and credit unions are simply not set up to lend to the vast majority of payday loan borrowers. In the past, a few credit unions have announced an alternative credit product to a payday loan, but in reality, it has never been offered on a scalable basis. In Alberta, for example, where over 1 million loans are made each year, credit unions have only managed to make a few hundred payday loans. We have found that most payday loan customers who apply for these alternative loans offered by credit unions are denied. The reason for this is that banks and credit unions will only lend to people with a credit score above 600. Millions of Canadians have scores below that, including the majority of payday loan borrowers. I've provided a graph to each of you today, which illustrates the range of payday loan borrowers for which access to credit from payday lenders is essential. It's important to ensure Ontarians have access to licensed, regulated, safe credit. Legislation and regulations must allow for a viable industry. January 1st of this year, Ontario reduced maximum rates lenders may charge to $18 per hundred, with the intention to further reducing the rate to $15 per hundred on January 1, 2018. The province of Alberta, without any meaningful consultation, introduced changes that fully came into effect on November 30th, 2016, and which included a reduction to a $15 maximum rate. Those changes are so recent we cannot determine the extent of impact on borrowers in Alberta. But based on conversations with many lenders, this much is clear. By and large, the payday loan product has been withdrawn from the licensed lending market in Alberta and has ceased to exist. Those borrowers on the lower credit rungs with lower credit scores are being denied access to credit entirely. The only option for borrowers on the higher credit rungs wanting a payday loan is to borrow higher amounts than they want for longer terms than they want. This is an example of bad policy that will hurt borrowers. Both the recent and proposed changes in rate are challenging the viability of licensed lending in Ontario, which in turn will affect borrowers' access to credit. The government needs to stop any further rate reductions and reconsider the maximum rate that is now in effect. I turn my time now over to Ms. Soper.
Thank you, Tony. I'm the head of public affairs for Cash Money, and I've been in this industry for 22 years. And I've engaged on short-term lending regulations in multiple countries. So I could speak on a number of areas, but I'll focus today on providing some lender-specific details on some topics which Tony just covered. In Alberta, we operate 28 stores. In December 2016, the first month in which the new regulations became fully effective, the number of payday loans that we granted in our stores dropped 94% from the same month in the prior year. And in the months of December and January combined, we lost just about $1.7 million. So clearly, we cannot continue to provide credit at this rate, nor can any other licensed lender. The Alberta government initially stated that credit unions would fill the gap. The credit unions have admitted to making just a few hundred loans as compared to 1.1 million loans made in Alberta each year. Borrowers will be forced to make other choices to access their money. Their need for credit doesn't just go away. As evidence shows in other restrictive jurisdictions, they will turn either to illegal online lending or experience costly overdraft fees, default fees, or reconnection fees.
Ms. Soper, I'm sorry to say, but you've used up your time.
Okay.
And we have to go to the Progressive Conservative Party. Mr. McDonnell?
Yep. Yeah, thank you for coming out. We see, I guess, a lot of hoopla done around this part of the bill. And I know that, unfortunately, your industry is kind of a punching bag. But we haven't seen anything done by this government to actually for an alternative. And we hear that you're talking about they've made your industry basically unviable in Alberta, and this follows suit. What alternatives do people have that where they're turned down by institutions and they need short-term money in a hurry?
Consumers that need short-term credit, that have impaired credit or thin credit files, that have a difficult time getting short-term credit from banks or credit unions, there really aren't any other options for them. So they usually end up with more overdraft fees, or they end up paying default fees or reconnection fees, and sometimes they even end up going online to illegal lenders. We have a lot of examples of this in other jurisdictions. where a high percentage of the transactions are done online by illegal lenders, where consumers end up paying more. So really, the demand doesn't go away. It just gets shifted to alternative inferior options. In Georgia, when they pretty much banned the product, in the very next year, NSF fees by the banks went up $38 million alone. So the demand just gets shifted to worse alternatives.
So I guess your example here of the bank, the NSF fees going up, it's another bad way of borrowing. It's an expensive way if you're just going to let your bank account overdraw because you have no alternative.
Correct.
Yeah.
And most of our customers, I mean, they are acutely aware of their finances. We find that 64% of our customers do not take the full amount that they qualify for. They come into our store with a specific need. They want to borrow the money just for that need and resolve their situation. They don't want to overdraft. They don't want a default fee. They don't want a reconnection fee. They want to handle their finances on their own, and this is the best alternative for them.
I suppose in some ways, it actually allows you to maintain your credit score. If you're short of money, very short term, to look at a reconnection or it could be a credit card bill that has to be paid for tomorrow or suffer the consequences. This can be a cheaper alternative versus going through the credit issues, defaulting on your credit card, losing your credit card, the like.
That's correct.
Yeah.
I mean, we've looked at the average utility bill that could be $300 or $400,
Yeah.
and between a default fee and reconnection fee, that can be $90.
Yeah.
That's significantly more.
Yeah. Any other examples of, would you see your customers coming in looking for money? Some of the reasons they're in there?
Certainly, you know, unfortunately, more than 50% of consumer households don't have any savings. So even the smallest unexpected expense every month can put their monthly household budget into the red. So consumers are coming in because it was a higher utility bill than expected. It was a school trip or something for their children that they didn't expect, and they don't want their children to be left without. It was repairing their car because they need to get to work because they can't be short any hours on their paycheck because their monthly budget depends on them working full-time hours. It's for all of those reasons.
Yeah. So we see people going in desperate need. We see every day people having issues with their hydro, and the number of times people are having them reconnect in the wintertime. This government hasn't given them an alternative. Actually, they're reducing the alternatives with this legislation.
That's correct. And like I said, I've been in the industry for 22 years, and I've actually worked in probably more than 8 countries. And I have seen in jurisdictions that have restricted the product where consumers end up, they still have that short-term credit need, and they'll go online and get it with an unlicensed lender. I mean, take Florida, for example, that has really tight restrictions and includes the reporting to a database. 84% of the online transactions in Florida are done by an unlicensed lender who, many of them, in fact, advertise on the internet non-database loans. So it becomes a very difficult situation, one where the consumers don't have any protections.
Mr. McDonnell, I'm sorry you've run out of your time. We'll go to third party, Mr. Singh.
Thank you very much, Mr. Speaker. Thank you very much for attending today. So you provided the example of Alberta and changes that resulted in the industry no longer being able to exist. What would be the lowest threshold that you could operate under in terms of an interest rate set?
It really depends on the market size. It depends on what the combination of restrictions are. And that's why we have a Deloitte cost of borrowing study that talks about all of the different operational costs, and that's hard to give you an answer without a number of other conditions in which to model. So that's why I hope that when you get to the regulatory process, that you have a data-driven approach to determine that.
And so I guess I put you in a disadvantage where you're not able to provide the answer without, is there a way we can say maintaining the existing regulation as they are and just on a strict interest rate level, what would be the lowest set possible that you think you could operate under?
Let me say this, that might put it in perspective for you. In 2015, our net operating profit was 10 percentage points below RBC and about equivalent to Meridian Credit Union. And that was before the rate reduced from 21 to 18, which was a 14% reduction in our revenues. So I understand some perspective is because we charge a high cost for lending, we must be making high profits, and that's actually not true. If you would look at our audited financial statements that we file and compare them to other industries, like I said, ours is comparable to Meridian Credit Union and 10 percentage points below RBC. I understand that you want to try to achieve the lowest rate possible for consumers and have a balance of consumer protection as well too, but there are costs to providing this type of service, and that's exactly why credit unions and banks just don't provide this service.
And are the costs because of, because I understand that the costs, if I'm wrong, maybe I should just say what my assumption is, then you can correct me if I'm wrong. The costs are not because, or I would assume the costs are because the consumer cannot pay back a loan. But that's not the cost. That's not why the rate has to be so high. There's other costs?
That's not it at all. And so we talk about our costs in 4 categories. One is operating costs, so our storefronts, our labor, our call centers. Another one is our centralized cost, like compliance and technology to deliver the product. Another one is our cost of capital. It might surprise you to hear that our cost of capital is in the double digit, so it's much higher because of where we can get our money for this type of lending. And then the final cost is our provisions for loan losses according to what our accountants require. So in all of those 4 areas of cost, that's what comes up with our total cost to deliver the product. It's not related to the losses on the product.
And what is your highest area of cost then of those 4 that you listed?
Absolutely operating costs. So our storefronts, labor, benefits, everything to operate those stores. This customer, it's a high-touch business. The customers are coming in. They're coming in evenings or weekends around their work hours, and they need a quick service so that they can get back to work or they can get back to what they were doing. So it is absolutely kind of a labor-intensive, high-touch business.
Okay. Thank you very much. No further questions.
You're welcome.
Thank you, Mr. Singh. We go to the government. Mr. McMeekin.
Yeah, thanks, Mr. Chair, and thanks very much for coming out. I have a little bit of history, albeit ancient history in some sense, but when I was Minister of Consumer Services, the last iteration when we went around this stuff, you were then known as the Canadian Payday Loans Association. You offered some very helpful material to us, and I always appreciated that and said so at the time and say so again, just for a historic perspective. Now, we're not out to ban payday lending. We're out to protect against predatory practices. I'm not just suggesting that that's necessarily the case here, but just if it were, that's what we're out to prevent. So I have 3 questions that I'd like to ask, Mr. Chairman. First, the premise of the Act is to protect consumers from financial harm. Does your organization support this objective?
Yes, we do.
Okay. The bill also provides authority to specify factors a lender must consider before making a loan. How do the members of your organization determine whether someone can afford a payday loan? And do the members of your organization consider whether consumers with outstanding loans have outstanding loans with other payday lenders?
I'm happy to answer that, Tony. There are a number of factors we do when we are reviewing customers' applications. So we absolutely verify their income, look at their source of employment. We look at their payment history and their borrowing history with us. We verify their identity. We may at times look at their FICO scores, although a lot of times we don't get a lot of information from that because our customers are kind of under the credit bureaus, not much information there. Right. So there's a number of factors that we come in, and a lot of lenders use proprietary scorecards to determine lending. So we're not in the business of lending out money that we don't anticipate getting back, because that would not be a viable business. So
it wouldn't be very smart.
Right. But it is challenging with our customer because we have to look at we have to use different data sources and look at different things in which to determine if what their credit risk is and what their ability to repay is.
Okay. The bill treats installment loans and payday loans differently. Are the consumers different? And if they are, do they need different forms of consumer protection?
The consumers of a short-term payday loan and a longer-term installment loan are different. So a longer-term installment loan is going to be a higher credit quality. So we're lending a larger amount of money for a longer period of time, and that's typically going to be a less risky borrower. But there are consumers that do like the single-pay payday loan because they have an issue. It's easy to budget. They know exactly when the repayment is due. It's a one-time repayment, and they want that product as well, too. I think the consumer protections are the same, and we are in agreement with any consumer protections. So clear disclosures, fee charts, any comparisons, any information to give the consumer, credit counseling assistance. I would say there are a lot of times, too, when our customers will phone us and they know that their due date is coming up and their pay date may have shifted by a day or something may have changed, and they've asked us to hold it for a couple of days so that they can come in later, and we do that at no additional fees or charges as well. So we are agreeable with consumer protections around disclosures and transparency and fees. I think our customers like the product because it's very simple. It's very transparent. It's one fee. It's due on payday. It's very easy for them to budget for.
So I appreciate your clarity and appreciate you coming in and understand that this is a fulsome and for all of us at times a somewhat difficult process, but change is going to happen, and you've been able to roll with that in the past. I'm hopeful that you'll be able to do that again as we proceed. Thank you.
Thank you.
Thank you, Mr. McMeekin.